Hey everyone and welcome back. Texas Roadhouse just released their latest financial reports and I've been covering this stock for the past few months, so I thought it would be an appropriate time to do a full stock analysis on this company. So what you can expect today is to go through the company itself, its industry, that sort of thing, economic moat, management, intrinsic value, and I'm going to be talking about some of the specific things that were brought up, some of the problems that arose in the conference call and in the latest report. So that is what you've got to look forward to for today. Hit the like if you enjoyed the video, but let's just get straight into the video. So Texas Roadhouse is a casual dining restaurant chain that was founded in 1993 in the US, and it's US based. They have their Texas Roadhouse chain restaurants, and they also have a new chain that they just started called Bubba's, and together those two, they have 549 restaurants in 47 states and 7 foreign countries. Texas Roadhouse has company-owned restaurants, but they also have a franchise model. So the company-owned ones are owned and operated and built by the company, and a franchise model is where a franchisee, some third party, is running the company, and Texas Roadhouse just takes a commission from them using the Texas Roadhouse brand, but they don't take any of the losses that are associated with those restaurants. So they do both, and that is what they have built their business on. Essentially, they have their company-owned ones, and then they slowly make some franchises, and within the franchise agreement, they have the right, but not the obligation, to buy those franchises. So they let the franchises build up their restaurants, and whichever ones are operating really well, Texas Roadhouse will buy them and assume all of the profits that come from that franchise. So let's now talk about competition, because this is one of the biggest factors that we need to consider when making our investments. What is the competition like in this industry? The restaurant industry is highly competitive and consists of many large and diverse restaurant chains, as well as individual restaurants from independent local operators. So as you can imagine, the restaurant industry is highly competitive for customers. Customers can choose from many different restaurants, and there is a huge supply of restaurants in the US at the current time, which means that it is very difficult for a restaurant chain to consistently bring back the same customers. And not only is Texas Roadhouse competing for customers, but they're also competing for quality staff and for quality locations for their new restaurants. Some of Texas Roadhouse's major competitors include Applebee's and Buffalo Wild Wings, as well as the Cheesecake Factory. However, there is no distinct massive market share leader in the casual dining segment. Another important component of analysis is to understand what the key business indicators are related to that specific company. So there's always specific metrics that are only relevant to the particular industry or even to the particular business. And we need to understand what they are so that when their latest numbers come out, we can interpret them and understand whether or not the company is continuing to perform as we expect in the future. So let's go through one of the major key business indicators for Texas Roadhouse. One of the key business indicators for Texas Roadhouse is their comparable restaurant sales growth, and this reflects the change in the number of sales from company restaurants over the same period of the prior year. So this is a number that compares the sales in a specific restaurant, and the sales of that restaurant will be impacted by two factors. One is the number of people coming in, the traffic growth of people coming through the doors, and the second factor is how much each of those people are spending. What is their average check size? And those two figures influence the comparable sales growth number, and that is a separate number that we need to look at, different to their total sales, because of course a restaurant business can grow their sales by building more restaurants, or they can grow their sales by having comparable sales growth organically within each of the restaurants. So that brings us to looking at the economic moat of Texas Roadhouse. And the economic moat is essentially some kind of competitive advantage that the company has over its competitors. Is there something unique? Is there a characteristic that we can identify within the business that gives it an advantage and ensures that it's going to thrive over the long term? So in terms of restaurant businesses, the main brand that they're all going to have is their branding and their innovation. It's how much customers love their food and want to come back consistently. And this kind of moat is what I would consider a narrow moat, which means that a restaurant business is very unlikely ever going to have a wide economic moat, a great competitive advantage. And the reason that a branding moat is a narrow moat, that it can be a competitive advantage, but it might not be sustainable over the long term, is because at the end of the day, customers can just choose to go to a different restaurant. There's nothing physically stopping them from going or physically making them consistently come back, like other business models where they have a subscription where people are actually locked into coming back. So there's a difference between wide economic moats that pretty much force customers to stay as a customer on their products, and then there's narrow moats where they can be sort of encouraged or persuaded to come back consistently because it's a great restaurant, but there's really nothing stopping people changing their preferences over time as customer preferences change and as new restaurant chains come out and develop. With that said, let's now have a look at the numbers for Texas Roadhouse to see if they tell us that they have some kind of competitive advantage over other companies in their industry. As you can see, Texas Roadhouse's numbers over the past 10 years have been outstanding. Sales growth between 10 and 12% every single year, very consistent and very strong. Earnings per share growth has been between 12 and 15%. Equity growth between 8% and 12%. Free cash flow growth has been between 8% and 35%. And owner's earnings, which looks at operating income minus maintenance capital expenditure, it has been around 12 to 18% per year and ramping up every single year. So those very strong and consistent numbers tell us that they do have an economic moat. There is something about their restaurant that is making people come back consistently and in strong numbers. And we've also seen this in their increased traffic numbers. However, I still need to conclude that it is a narrow moat. So while it's been strong for them in the past, over the next 10 years, we can't be overwhelmingly confident that they're going to be able to continue it. It's likely that they will, but we can't be very confident, and that is the kind of business we're looking for. We're looking for a business that has a wide economic moat, where we are very, very confident in their ability to continue to perform at a great pace into the next 10 years. The next component of our analysis is to assess the management, and we need to assess the management's integrity as well as their skill. Do we trust them? And are they good at investing within the business and managing debt? So let's zoom in on one of those parts of management's analysis by looking at their capital investments, by looking at their return on invested capital. Texas Roadhouse has maintained a return on invested capital of above 8% since going public and has grown their ROIC from 8 to 17% since the global financial crisis. Having very strong and consistent return on invested capital gives us confidence that they can generate free cash flow and reinvest it into the business to grow it into even more free cash flow. And that consistent high ROIC tells us that they're generating large amounts of free cash, and then they have tons of opportunities around them in order to invest and build out new restaurants, and those restaurants are being successful, which is generating a huge amount of profit for this company. And as we saw on those numbers, they are doing it very, very consistently and at a high rate. So that finally brings us to looking at the intrinsic valuation. So we've determined that it is a pretty good business, although it is not perfect, as we saw with that narrow economic moat. But now that we've identified that it's a pretty good business, how much cash are we going to get back from it? What can we estimate that we're going to get back? And therefore, what are we willing to pay based on the fact that we want to make at least a 15% return over the next 10 years? So having a look at the value matrix, we've used a few assumptions here to reach our conclusion. We've put in our growth estimates between 2.5% to 12.5% per year based on their past growth and growth in the industry. And we're assuming that they're going to be able to achieve a PE ratio of somewhere between 10 and 30. The current earnings per share is $2.14. We're looking over 10 years, and the current price at the time of recording is $54 per share. And in the bottom table, we can see what the price of the stock will be based on these assumptions in 10 years' time. So assuming 7.5% growth, for example, and a 20 PE, the stock price in 10 years will be $88.21. And on the top table, that translates into a return or a gain in the stock price per year. So if they grow at 5% per year, for example, and have a PE of 15 in 10 years' time, then the return will be just about zero. It'll even be negative. Now we need to remember that Texas Roadhouse also pays a dividend, so we're going to be receiving a dividend on top of this return. But as you can see, at the current stock price, there really isn't a great return unless the company continues to be an outstanding performer. And we're looking to be conservative in our valuations, in our assumptions, so that if they underperform, we're still going to make a good return. And if they perform as they have in the past, then we're going to make a great return. You can see now that if we were to pay somewhere around $25 per share, however, the return is a lot better, meaning if they can achieve 10% as they have in many of the years in the past, and they have a PE of 20, then you're going to get back about 16% per year from the stock price, plus another 2 to 3% from the dividend, which means you would almost make a 20% return per year if you paid around $25 per share. Now, those were some of the highlights from my analysis of Texas Roadhouse over the past few months, but if you want to see my full written report, that's a 10-page written report, and my 1-hour analysis presentation on this business, then you may want to consider becoming a member of the Learn by Example platform and community. Members get access to new stock analysis reports and 60-minute presentations every 14 days to help you learn to consistently find low-risk, high-return investments in your own research, as well as our private Facebook community where you can participate in Q&A live streams, discussions, and more. So if you are someone who wants to take your investing to the next level and want to see real life examples of full stock analysis and have a private community to help you learn how to invest consistently over the long term, then click the first link in the description below and you can find out my exact 4-step process for consistently finding these types of investments. And at the end of the video, if you're interested, you can book a call with me where we can have a discussion and work out whether or not you would be a good fit for joining our community. But that's all from me for today, guys. I hope you enjoyed it. Leave a like if you did, but for now, guys, I'll see you in the next video.